Okay, S&P futures are down 0.4%. The pre-market tape is heavy.
Yeah, it is.
We're retreating pretty sharply from those recent record highs.
Yeah.
But then you check the screens, and the official institutional sentiment is just stubbornly stuck at neutral.
Right.
How do you reconcile that? It feels like we have conflicting signals everywhere. You've got political threats hitting bottom lines, but then you have mega cap tech surging on AI news.
That conflicting signal is exactly what we need to decode for you today. This is the whole point of this deep dive.
Okay.
Our mission is to move past the headlines and really unpack the raw institutional data to show you how these massive external forces, and we're talking non-economic risks.
Things like politics.
Exactly. Political threats coming straight out of D.C. and these structural supply issues in the bond market, they're completely overriding traditional market momentum right now. They're creating a very specific and, frankly, dangerous trading environment, is what the desks are calling a liquidity trap.
So we've got that classic high-stakes macro Wednesday setup. I mean, we are just minutes away from the December PPI and retail sales data drop at 8:30 a.m. Eastern.
Yep.
And we know that data will move the needle, but it feels like the big story today isn't really about the inflation figures. It's about these other non-economic wildcards.
I agree.
So if we just set the economics aside for a second, what is the immediate non-economic catalyst that's putting this heavy weight on the market this morning?
The real weight, surprisingly, is political. It's coming directly out of Washington, D.C., and it is hitting the financial services sector the hardest. And it's not some, generalized anxiety. There are two very specific political catalysts causing all this market indigestion right now.
Okay, let's unpack those two threats because they sound pretty high impact.
For sure. Catalyst number one is the credit crunch threat. President Trump has proposed a 10% cap on credit card interest rates.
A 10% cap.
A 10% cap. Now, this isn't just about consumer savings. This is about the entire payments ecosystem. It's about the core profitability model of major banks and credit processors.
You're talking about slashing net interest margins.
By a significant, irreversible amount. It's an existential threat to that entire business vertical.
Okay, and catalyst number two.
Catalyst two is pure regulatory uncertainty. It's all about trade. The market is bracing for a potential Supreme Court ruling on executive tariff authority.
Wow.
This is a massive overhang. If the Supreme Court rules against the current executive power, it could just instantly shatter the current very fragile trade equilibrium.
That second one, the Supreme Court ruling, that sounds like a textbook black swan event. I mean, that could just instantly destroy this neutral market sentiment.
It absolutely could. It turns a potential risk into immediate, measurable action on global supply chains.
And you can see it already, can't you?
Oh, absolutely. You don't need to wait for the ruling to see the risk priced in. You see it immediately in the downside movers. Just look at Visa V's down nearly 5% pre-market.
5%.
Why? Because that proposed interest rate cap directly threatens their entire core processing revenue model. When your whole business is exposed to consumer finance margins, a political mandate like that is a direct, undeniable hit.
And it's not just the payment processors feeling the squeeze. I mean, JPMorgan, one of the banking giants, is sliding this morning too.
Yep.
They're dealing with their own internal pain on top of this political pressure.
Exactly. JPM shares are sliding because they missed analysts' estimates on investment fees. That's a revenue problem. But more specifically, they confirmed a concrete, non-trivial $2.2 billion financial hit.
$2.2 billion.
Linked to their complete exit from the Apple Card partnership. I mean, to put that number in context for you, that's a massive amount of capital. It tells us how much banks are willing to pay just to get out of these complicated, unprofitable relationships.
So you have a 1-2 punch in the financial sector.
You do. Confirmed financial hits from bad deals, combined with these existential external threats from the political landscape.
That's a really clear map of the pain trade in financials and credit risk. But capital always has to flow somewhere. So amid all this uncertainty, what is managing to rally? Where's the refuge?
That takes us straight to the fundamental rotation that's already in progress. It's a move away from political risk and toward certainty. Intel, INTC, is bucking the trend. It's up a solid 3% pre-market.
Okay.
And this isn't just random noise. It's driven by a key bank upgrade, specifically based on surging AI data center demand. This confirms that institutions are fleeing complexity and they're focusing laser-like on infrastructure plays.
Semiconductors, hardware.
Exactly. Things that benefit from massive multi-year spending cycles. The AI revolution is now officially a safe haven trade.
Okay, so the pain is in financials, refuge is in infrastructure. Let's map how this uncertainty is showing up on the charts. You mentioned this idea of a liquidity trap. Can you map out what that means, especially since yesterday's strong momentum has just stalled out?
That stall is the midweek hangover. Yesterday's upward momentum has, well, it's essentially vanished, and we're seeing a classic value area rotation, meaning we're in the price range where most transactions have occurred recently, and right now volume is thinning out aggressively at the previous highs. That tells institutional desks one thing: the easy money move higher is definitively over.
We're stuck. You call this a liquidity trap.
Yeah.
For someone watching their retirement account or, just trying to understand the market's pulse, what does being stuck in that trap actually mean?
It means frustration. It means deception and deliberate chaos. Market makers are actively hunting stops.
Right.
They are pushing prices just far enough to trigger all those automatic sell or buy orders from the smaller participants.
Only for the price to reverse instantly.
Exactly. It's an environment designed to shake out anyone without conviction. It creates this massive volatility without any real directional clarity. The market is just waiting for the 8.30 data.
That makes the specific technical levels even more crucial then. So what are the battlegrounds we need to know in the S&P 500 futures, the ES?
The psychological pivot for the S&P is 6,145. This is the high volume node we mentioned, the price where most of the trading has happened.
Right.
Above 6,145, the bias is still bullish. We kind of grind higher. If we drop below that, we are officially in stop hunt mode. And more specifically, if we break the deep support at 6,110, that's the tripwire.
That's when the trap is sprung.
That is when the trap is sprung. It signals a very fast move lower, probably targeting 6,075.
So 6,145 is the pivot, 6,110 is the trigger. What about the tech battleground, the Nasdaq Q100, the NQ?
The Nasdaq Q battleground is concentrated right around 21,250. The price action here is going to be incredibly choppy, a real tug-of-war.
Why?
Because the market is trying to weigh the good news, that strength in semis from Intel against the pressure from these persistently rising yields, which we need to get to. Resistance is heavy at 21,420. But the key insight here isn't just the number.
It's the condition of the momentum.
Precisely. Big tech is exhausted on a short-term basis. The momentum oscillators are severely overbought. The rubber band is stretched way too far.
Which means the risk-reward shifts.
It does. A pullback is far more likely than a breakout. The institutional money knows that buying big tech right here, right now, ahead of all this data and political risk, is a very low probability trade. They're waiting for mean reversion, not chasing a breakout.
Okay, so that gives us a pretty concrete playbook for the opening drive. The institutional strategy in this trap is what?
Fade the extremes. You don't want to get stuck trading in the middle of this frustrating range. You sell the first test of resistance, you buy the second test of support, but the most important thing is to recognize the deception.
So the opening drive.
Watch that opening drive. The first 30 minutes, it's going to look exactly like a decisive breakout in either direction, only for it to fail at the 30-minute mark and just revert right back to the mean. You have to stay light on position size until London closes.
Okay, that covers the technical map and the political noise. Now let's connect the structural macro drag. We know inflation is cooling. December core CPI was only 2.6%.
Right.
But despite that, the 10-year Treasury yield is refusing to drop. It is stuck at 4.18%, a 4-month high. If the Fed is signaling cuts, why is the bond market just ignoring the Fed pivot narrative?
This is the critical macro explanation. This is what you need to understand. It all comes down to fiscal friction. It's a conflict between monetary policy and government spending.
But hold on, if inflation is really cooling, shouldn't the market be discounting the massive Treasury supply? Why is the term premium overriding what the Fed wants to do?
Because the supply is just overwhelming the demand. It's forcing the price of debt lower and the yield higher. The bond market is demanding a significantly higher term premium. That's the extra compensation investors need to hold long-term government debt, specifically to absorb the sheer massive supply of bonds being issued.
Which is coming from?
It's coming from ongoing enormous deficit spending. It's linked to Congress's recent legislative action, what some are calling the One Big Beautiful Bill Act, or OBBA. The Fed might want to cut rates, but if the Treasury keeps flooding the market with debt to fund huge spending gaps, the bond market forces yields higher regardless.
That is a fundamental challenge that completely overrides monetary policy. It creates a structural floor for rates. And this high yield at 4.18% creates a painful double squeeze on the whole Nasdaq. How does that work?
It's two major pressures converging on high-growth tech. First, High yields directly and instantly compress PE multiples.
Right.
Tech valuations are based on future growth, so when the discount rate, the 10-year yield goes up, the present value of those far-off earnings just drops. Tech is worth less today simply because rates are sticky.
And the second pressure.
The U.S. dollar index, the DXY, is firm. It's stalling around 99.15. A firm dollar eats directly into the global revenue of large tech companies, the Mag 7, because their overseas profits translate back into fewer dollars. So they get no currency tailwind, only headwind.
High yield hitting valuations, firm dollar hitting margins. That explains the rotation. Let's synthesize this macro drag with where the capital's moving.
Okay, we've established money is fleeing the credit risk trade, those banks and payment processors like Bank of America and Visa, and it's seeking refuge in infrastructure certainty.
Semis and energy.
Primarily semis and energy. Right now, energy, the XLE, is the strongest sector across the board.
And the catalyst for that strength is entirely external too, isn't it? Another political factor.
Absolutely. WTI crude jumped 2.6% overnight, sitting at a crucial level of $61.01. The specific catalyst is news that the Trump administration is signaling a potential 25% tariff on any country that continues to do business with Iran.
And that immediately creates geopolitical friction.
And tightens global supply expectations. When supply gets threatened, hard assets like oil become extremely attractive.
Let's nail this down with a couple of stock specifics. Bank of America, BAC. They're facing earnings and that massive political headache.
BAC is a prime example of the credit risk trade under duress. The bear case level you have to watch is $46.
$46.
That's key. If management warns on their call this morning that this rate cap will force them to contract lending or take material hits, you will see sustained selling push them to that level quickly. If BAC and the other financials break, that's a huge bearish signal for the entire market.
And then on the other side, the potential cash cow, Apple, AAPL. Even after confirming that huge AI partnership, there's still political drag.
Yeah, Apple is seeing really high relative volume after confirming the Google Gemini AI partnership. You have analysts rushing out with street-high targets, citing a renaissance of the iPhone cycle.
Right.
But you still have to watch the bear case level, which is tied directly to that political drag from tariffs. The $245 pivot is the line in the sand. A failure there signals a deeper technical retracement despite all the AI optimism.
So if we put it all together, the political risk, the technical trap, the macro drag of high yields, what is the ultimate mistake a general investor should avoid today? What is the institutional pain trade?
The ultimate mistake, especially if that 8.30 data comes in hot, is getting caught in the long duration trap. This happens if the 10-year yield breaks the critical 4.25% resistance level today.
Describe that trap. The retail mistake versus the market reality. Why do those high beta names suffer so much when yields spike?
The retail mistake is bottom fishing. It's buying the dip in small cap and unprofitable growth tech, the high beta names. Betting the Fed is about to swoop in and save them with rate cuts.
That's the hope.
That's the hope. It's a bet on a Fed-driven rally. The reality is, if yields spike above 4.25%, these names collapse first. Their future cash flows are instantly worth drastically less, and their cost of capital resets higher overnight. Many of these companies rely on cheap debt to survive.
So while retail is betting on the Fed saving the speculative names, what is the smart institutional move?
Institutions are rotating, and rotating aggressively, into high-quality cash cows. We're talking tech and industrial firms with zero net debt, massive free cash flow, and reliable buyback programs. They thrive when the cost of capital suffocates everyone else because they don't need to borrow.
So the final synthesis for today is discipline. Trade the levels we laid out and follow the money out of complexity and into certainty. And we watch for that neutral sentiment to turn officially bearish if financials like BAC and Wells Fargo confirm the political pressure with bad earnings.
Precisely. Watch the key pivots and follow the money. Out of credit risk into infrastructure certainty. The market is in a waiting game.
Okay, to quickly recap the key watch points, the S&P psychological pivot is 6,145. On the macro side, the 10-year yield resistance level to fear is 4.25%.
And this raises a really important question you should be mulling over all day. We spent the last year expecting a Goldilocks soft landing, right? Driven by the expectation that the Fed would slash rates.
Right, back to cheap money.
But we've discussed how sticky yields are replacing that expectation. So if the bond market is consistently demanding a higher term premium because of this massive persistent fiscal friction, are we actually entering a new reality? A reality where persistent government debt defines the interest rate floor, regardless of what the Fed tries to cut?
That is the big shift. The 10-year yield action above 4.2% today tells you everything you need to know about that potential new reality. Stay alert, and we'll see you on the flip side.